Yeah, hello and welcome everybody. Here we are now with a video with some cases showing how the exemption method works. But before we do these cases, a small repetition how things like these have to be dealt with. So first, let's have a bit of theory again. So the question here is, how are cases with exemption method done? So what do you have to do? The recommendation is just act regularly, follow the usual scheme for checking a tax case. That means the first step is personal tax liability. So limited or unlimited. Second, check the events. So what is the type of income? What's the tax base? And so on. And the third is remaining last questions, if any remain. Then, what do you do next? You keep one thing in mind. When you check the events and something is tax-free, then you cannot ignore it completely because, well, the exempt events, they might be relevant for some particular question for the proviso safeguarding progression. For that, you might still know how high the income is and if it is income at all. So you have to test it regularly, find out the amount, and then say that it's tax-free. So what you need to do with each event is, first, is it income? And which type of income is it? Second, what is the relevant tax base? So find out the numbers. And now, if it is exempt, make a note that taxable amount is 0 and note the real amount for the proviso rule. So at the end of the case, when you have through all the events, you can note, make a small table on the left, the taxable amounts, on the right, the amounts for the progression. And then, as an example, just to show you finally how it works, on the left side, the taxable amounts, on the right side, the amounts for the progression. And then let's now assume we have concrete data. So 100,000 shall be taxable. So they are also relevant for the progression calculation. Now a second event is tax-free, so taxable is 0, but it shall be 300,000 income. So when we sum up, we have on the left side taxable amount of 100,000. And we have on the right side for the progression calculation, which shows your real wealth worldwide, you have 400,000. Now the next step would be to calculate the tax which would be triggered by 400,000. Then to say how much is this in percent, here 37.75, and then you apply that percentage to the taxable amount and get the tax. And that's it, plain and simple. So that is our case. Thank you very much. Okay, let's begin with the first simple case. Here is a GmbH from Aachen in Germany, and that has the following income this year. A has income from a shop in Aachen, that was 200,000 euro, and income from a shop in Den Haag, Netherlands, that was 500,000 euros, so 500,000. The shop in the Netherlands is tax-free in Germany under the double taxation treaty with the Netherlands, because there the exemption method is declared to be applicable. Now the question is, what is the German corporation tax for a GmbH during this year? And that is a simple thing which we have to deal with and solve immediately. Okay, so we will do the usual thing and begin with the personal tax liability. That's something to do just now. personal tax liability. And here we see that a GmbH is a juridical person. So KSTG applies. And it is unlimited tax liability taxpayer. See paragraph 1, number 1 of the KSTG, because seat or place of management both is in Germany. Now let's check the events. I recommended to you that when we have to do with the events, one by one should be checked. So, but with a corporation, we can simplify, for example, the question which type of income we have, and if we have a type of income, because all income of the A GmbH is deemed, so a fiction, to be income from business. See paragraph 8 to KSTG. And even before, we might make a small initial remark, which we already know. The tax or the income has to be determined for a GmbH according to the rules of the Income Tax Act plus KSTG rules. Now everything has to be seen as income from business, so we can be reasonably sure that the shop in Aachen is income from business, and the amount is 200,000. That is given here in the case. Now, event number 2.2, shop in Den Haag, Nederland. It's income from business. See above. The amount is in theory 500,000, but tax-free, so taxable is 0. Now, is there something relevant for the proviso safeguarding progression? And I print that in italics because the reason for that you will directly see in corporation tax in Germany. There is no progression, so tax-free amounts cannot be relevant for progression. So we can ignore this also for the tax rate calculation. We do not make that different tax rate calculation in the KSTG. The progression only plays a role in the ESTG. So adding it all up and calculating the tax, simply taxable income 200,000, rate 15% according to paragraph 23, section 1 KSTG. So the tax is 30,000 euro. That's everything what was to say to this case. So case closed, finished, and we are all happy and can now turn to case number 2. Here now we have another case, B GmbH. So again, a GmbH from Bonn in Germany has the following income this year: income from a shop in Bonn plus 500,000, and income from a shop in Den Haag, Netherlands, minus 300,000, and the DTT, the double taxation treaty, grants the exemption method for that shop. So how high will the German corporation tax for this B GmbH be for this year? So let's begin at the beginning, as we are used to. The first step is again personal tax liability. So we have B GmbH, that's a juridical person, so we know that KSTG applies. Then the next step is it is unlimited tax liability, what we have given here, because the seat of the GmbH is in the German inland, so that is triggered by number 1 KSTG. The events. We can if we want to make a general introductory clause which says all the income has to be determined according to the rules of ESTG and KSTG, that is to be found in paragraphs 7.1, 7.2, 8.1 KSTG, plus an additional remark that everything which the GmbH earns worldwide will automatically be classified as income from business 8.2 KSTG, because legal forms like GmbH, AG, SE, limited, and other comparable forms, if they are unlimited tax liable in Germany, automatically have everything what they do reclassified into income from business. Now we have the shop in Bonn as a first event. That's income from business, naturally, and the amount is 500,000. The second thing is a shop in the Netherlands. The income is again from business. Now we have an amount of minus 300,000. That's a loss. But due to the double taxation treaty, this loss is tax-free. So taxable amount is for the Netherlands in Germany a zero. Relevance for progression? No, because there is no progression under the KSTG. So no additional auxiliary computation is necessary, and we don't need to collect any data for such an auxiliary calculation. So addition and tax calculation is simple. The taxable income is 500,000 only. We have a tax of 15% according to 23.1 KSTG. So we end up with 75,000. That's it. Case closed. Everyone happy. And we are ready to deal with the next case in line. Now, naturally, there is one additional remark to be made. Sometimes a GmbH or AG or what else, or a natural person has several sources of income from foreign states, and then naturally the exemption method can only apply to those activities for which it has been granted. All the rest, the remaining activities abroad, remain taxable. They will be treated as usual, for example, under the credit method or the deduction method or whatever you find out. So to illustrate this, we have again another case. This is now case number C. C GmbH from Chemnitz in Germany has income from a house in Germany, a shop in Nijmegen, tax-free under the double taxation treaty with the Netherlands, and a shop in the foreign country of Abrodia, which is evidently abroad, a country without a double taxation treaty with Germany, 300,000. So how has this case to be treated? And that is, well, not really complicated. So let's simply do it. We begin again with personal tax liability. So C GmbH is a juridical person, so KSTG applies. We have unlimited tax liability under paragraph 1.1, number 1 KSTG, because seat is in Germany. We have the events to be checked. This is income to be determined according to ESTG and KSTG. See the usual paragraphs. That was 7.1, 7.2, 8.1 KSTG. By the way, from time to time you should have a look into these paragraphs just to know them. All income is from business, paragraph 8.2 KSTG. And here we have 2.1, the house in Germany, that is 100,000 income from business. Now, why from business and not from lease and rent? And the answer is 8.2 KSTG. It says everything which that German GmbH does is classified as income from business. The shop in Nijmegen is tax-free, so taxable is a zero amount. And the 2.3, the shop in Abrodia, a foreign country, that's income from business, 300,000 euro. No modification by a double taxation treaty, so general rule remains valid. The 300,000 are taxable in Germany. So adding it all up means we have taxable amount of 100,000 because of number A, plus 0 because of number 2, and we have 300,000 because of number 3. That's a total of 400,000. 15% on that, part of 2131. So we end up with a tax of 60,000 tax. So case finished, case closed, everyone is happy. Now, if you wonder if there might be a credit method applicable for the income from Abrodia, yes, that might be possible. However, we do not know anything about the tax which was levied there here in the case data. Perhaps they don't even have an income tax there in Abrodia. We do not know. We can't speculate. The decisive thing is that is the German income tax here. Okay, so case C solved again. Everybody is happy, should be happy, should be ready and prepared for the next case to exercise the exemption method consequences. Now, this, ladies and gentlemen, could really not be a surprise for the intelligent ones under us or among us. The GmbH is now in play. It's from Dortmund in Germany and has the following income. A shop in Dortmund brings an income of plus 100,000. A shop in Munich an income of minus 200,000. A shop in Vienna in Austria brings 300,000, which is tax-free under the DTT Austria. A shop in Nijmegen is 400,000 tax-free under the DTT Netherlands, and a shop in the USA is 500,000, which are tax-free under the DTT USA. What happens? That seems to be a nice idea. Let's find it out. Well, we have again personal tax liability, and now you will probably get in a deep and inner and profound understanding for why this channel is called the Boring Lectures channel, because it's again the GmbH is a juridical person, so I'm now bored myself. So KSTG applies. It's unlimited tax liability under number 1 KSTG, and we have the events, blah blah blah, everything is income from business, paragraph 8.2 KSTG, and now we have the events. The shop in Dortmund and the shop in Munich are both income from business, are taxable because not freed of tax. So we have plus 100,000 minus 200,000. So we have here a subtotal of minus 100,000. So we have a loss in the inland. 2.3 shop in Vienna, income from business but tax-free in Germany, so taxable is 0. The same applies to 2.4. The shop in Nijmegen, Netherlands, is income from business but tax-free, so we have plus 400,000. No, we have 0. 2.5 shop in the US, tax-free in Germany under the DTT, so taxable in Germany is 0, not in ERSO. So we have total income taxable in Germany, that's minus 100,000 this year. So what we get for this is a loss carry forward. We pay no tax this year, and the loss of this year can, under certain conditions, be deducted from future profits which are taxable in Germany. That's a so-called loss carry forward. But the important thing here is when you look to the overall situation, you see here that gains or profits and losses within Germany could be offset against each other. So there were no taxes to be paid on the 100,000 in Dortmund because they remained taxable and could be offset against the shop in Munich. So in the end, we ended up here with paying no tax. But the loss and profit compensation, so netting the one off against the other, was not possible with the positive but tax-free amounts from the other states. So here you see that if you distribute your activities over several states and are taxable in different states, then you have some economic disadvantages because the netting off of losses against profits cannot be made in such an easy way as in an inlet constellation. Well, that's rather a bit of theoretical blah blah, so what you simply keep in mind that probably this case could also be solved without any major problems. It was a bit surprising that nearly everything outside Germany was in that case by coincidence tax-free by a double taxation treaty, but well, shit happens or strange things happen, so well, it is as it is. The case is solved, we should be happy and go on. Now for the first time something nicer, something more natural, because Mrs. E from Essen is a natural person, so a bit more natural than the other cases. So Mrs. E from Essen, Germany, has the following income. From a job as a teacher in Essen, she gained or she obtained 50,000 euro income. From a share in a partnership which runs a factory in the Netherlands, she gets 150,000 euro. This income shall be tax-free under the double taxation treaty with the Netherlands. Naturally, a natural person has special expenses and extraordinary expenses, so personal tax-free allowances. The total amount here is 10,000. So there is only one question which comes up now. What are we going to do with this case? And the answer is plain and simple. We are going to solve it, and that is to be done as follows. Now let's again begin with the personal tax liability, and now the big surprise comes. Mrs. E is a natural person, so ESTG applies. She is unlimited tax liability, paragraph 1 ESTG, because she lives in the inland, because she has her residence or home at Essen. Now, the events. 2.1. Job income is income from employment. That's paragraph 19.1, number 1 ESTG. Current salary is income from employment. So that's a part of the worldwide income. If we want to confirm that, the tax base which is needed is the surplus of revenue over expense, for those who want to know it, and for the others who don't want to, here given as 50,000 positive. Now 2.2, the share in the Dutch business. That's income from business. 15.2 says what the business is, and 15.1 number 2 says if you are one of the partners in a partnership which run the business, you have to pay taxes for your share in the profit. So the taxable amount is here 150,000, but tax-free. So taxable amount is 0. Is it relevant for the progression? That is to be assumed, and to test is naturally the legal source for that 32B ESTG. So we should try to have a look into that particular legal rule. Well, here we have that particular legal rule. Here is a list of all that taxable about tax-free income, which plays a role for the auxiliary calculation, which is necessary for determining the socially adequate tax rate for an income taxpayer. And so we see here 32B, paragraph 1. A special tax rate is to be applied to the income mentioned in paragraph 32A1 ESTG if a taxpayer who is subject to unlimited tax liability, blah, 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 has got during that period, and then comes a list of tax-free income or not tax-relevant income. And number 2, for example, says foreign income which does not underlie the German income tax liability at all. Or number 3, income which is tax-free under a double taxation treaty. So that is the case here. We have later in sentence 2, for income from the EU, the proviso suspended for certain cases, especially for those investments which are not combined with any risk. But if we check that list of exemptions from the proviso calculation, we find that, well, it only covers investments where there is no risk at all, and mostly at least. So a regular factory doesn't show up here. So for income for a factory, we still remain, or still this number 3 rule remains valid, that income is relevant for the proviso safeguarding progression, so we have to take it into account. So after we could happily say that, we could say relevant for progression is 150,000 plus. So now adding it all up, let's make 2 columns, taxable and relevant for progression. So taxable is an amount of 50,000. No, not minus, but plus. Naturally, that was a typing mistake, a mere typing mistake. Naturally, as it's taxable, it also counts for the all income calculations. That's a 0, but for the progression, it comes into play with 150,000. Then we have the personal expenses. Naturally, when everything is taxable, these are also existing and deductible. So we have here a taxable income of 40,000 euro to be taxed with the appropriate tax rate for 190,000 euro, because that is relevant for the progression. Now, if we want to calculate what is relevant for the progression, the tax for 190,000 would be 0.40% minus a correcting factor, 9,000. Oh my God, what was it? 9,000. Let me look it up. 9,267.53. That was the variant for 2022. And so we end up with 190,000 times 42%, 79, no, sorry, that's 79,800 minus 9267.53, and there we end up with 7530. Now that would be in percent divided by 190,000, so that would be 37,12% and a bit some digits more behind the last comma, but that doesn't play a big role. No? This rate applied to the taxable income of 40,000 leads to a tax of 40,000 taken times 37.122%. That is 14,448.94. Probably we round that down, but that is not a big affair. And so again, we have solved our case, should be happy, and could go on to the next case soon at least. Now here is now Mr. F. And Mr. F is from Frankfurt, Maine, and has income from the following sources: income from a house in Germany, income from a job in Frankfurt, and income from a factory in France, and that income is tax-free under a double taxation treaty. The personal expenses, which are deductible, amount to minus 50,000, and that again seems to be an interesting and simple case, so let's just work on it. So the beginning is clear again. Personal tax liability, we have F is a natural person, so ESTG applies. We have unlimited tax liability, paragraph 1(1) ESTG because residence in the inland Frankfurt, so that the worldwide income is relevant. Let's look at the events. House in Germany, that is income from lease and rent. Paragraph 21(1), number 1 ESTG says so it's a part of the worldwide income. That is to be found in 2(1), number 6 ESTG. The tax base needed is the surplus of revenue over expense and not profit. So that's it. And that's here given with 20,000, so we don't have to worry about all that. Now, second question, second transaction is the job in Frankfurt. That is income from employment. Paragraph 19(1), number 1 ESTG says so part of the worldwide income. 2(1), number 4 ESTG. The tax base is the surplus. 2(2), number 2 ESTG again. That is completely uninteresting for everyone. And here's a very good job, 80,000. So 3(3). The factory in France, for example, he might have inherited that from a grandfather or so. We don't know how somebody having a job in Frankfurt can also be the evidently sole and only owner of a factory in France, but it's possible. And if it's possible, evidently here it has happened. It's income from business. 2(2), paragraph 15(1), number 1 ESTG. So part of the worldwide income because it's part of the 7 types of income. The tax base for income from business is the profit. 2(2), number 1 ESTG. That is usually determined by balance sheet, and it's here given as 500,000, but it's tax-free, so taxable is 0. But it's relevant for the proviso safeguarding progression. That was paragraph 22(b)(1), number 3 ESTG, because tax-free amounts under a DTT are in general relevant for the proviso. The exception for certain cases inside the EU does not apply here. It's a bit too complicated to go into details here. So relevant for progression is 500,000 plus. Okay, so we go to addition and calculation of the tax. We make two columns, taxable amount and relevant for the progression. So we have a taxable amount of 20, and as it's taxable, it also counts for the auxiliary calculation. That's clear. 80,000, and also that counts. Then we have 0 from France and 500,000, which count for the auxiliary calculation. So then we have 50,000 deductible personal expenses and 50,000 here. So we have a total in both cases. The total here is 50,000 taxable income. And we have a progression which is to be calculated on the basis of 550,000 relevant for progression. Now, the tax for the 550,000 would be 550,000 times 0.45 minus a correcting factor, which takes into account the fact that not everything costs 45%, but the first brackets of the income are taxed with a lower percentage. So we need to look up how high this correcting factor is this year. Now, if we take a look to the tax tariff for 2022, we see that the correcting factor for the highest bracket is 17,602.28. So that is the number which we need to insert into our calculation. So let's bring it into our solution. 17,602.28. That leads to a tax of 247,500 minus 17,602.28, which is then again 292,897, and this has to be rounded down. And now in percent, that is that divided by 505,123,000. That's 41,79958%. So that rate applied to 50,000 leads to 20,899.79, so rounded down 99. Okay, that is again a case which now has been solved. So congratulations to ourselves, happiness everywhere in the country and before the screens. But what are we going to do next? It's clear we are going to look on the next case. Now, here is the next surprising effect, because when we take into account the proviso safeguarding progression, this could also backfire for the fiscal administration, because the proviso could also include a negative part of the income in the tax calculation. So here we have Mr. G from Gerolstein in Germany, and he has income from the following activities: a job in Gerolstein, a house in Cologne, which has led to tenants, and a loss from a factory in France, where the exemption method applies under the double taxation treaty, and special expenses amount to 10,000. So let's have a look how that will be dealt with. And now, surprise, surprise, we begin as we always begin. Personal tax liability. Boring as it is. G is a natural person, so DSTG applies. G is unlimited tax liability taxpayer. And the 1 ESTG because lives in the German inland, Gerolstein. So the worldwide income is relevant for his tax. The events. 2.1, the job. That's income from employment. Paragraph 19.1, number 1. So part of the worldwide income, which we need. 2.1, number 4, ESTG. The tax base is the surplus. That's 2.2, number 2, ESTG, and that is here given with plus 67. The next event which we have and which comes into play is the house in Cologne, and that house brings us income from lease and rent. 21.1, number 1, ESTG. So part of the worldwide income. Under 2.1, number 6, tax base is the surplus of revenue over expense. 2.2, number 2, ESTG, here given as 40,000. 2.3 is the factory in France. That is income from business. 15.2 plus 15.1, number 1, which says sole proprietor. The factory has to pay taxes for the income from the factory. So part of the worldwide income. Paragraph 2.1, number 2, ESTG, relevant is as tax base the profit. 2.2, number 1, ESTG, here given as minus 80,000, so a loss. But tax-free under the DTT, so taxable amount is 0. Relevance for the progression? And the answer is yes. Under that strange paragraph 32b, number 3, ESTG, because it is tax-free under DTT, it counts for the progression, and the exception laid down in paragraph 32b, 1 sentence 2, numbers 1 to 5 does not apply. Here, believe it, just believe it from me. So for progression, we have to take into account minus 80,000. Now, number 3, adding all up. We have taxable and we have relevant for tax rate. So for the progression, taxable is 60,000 and relevant is 60,000, 40,000, and relevant is 40,000. Then we have the factory 0 and relevant for the tax rate with 80. Then we have minus 10,000 and relevant for the tax rate. Also the personal deductions would count. If we sum that up, we end up with a taxable income of 90,000, which has to be taxed for the rate of 10,000. Now, the tax for 10,000 worldwide income is approximately 35 euro. So that would be in percent 0.35%. That rate applied to taxable income of 90,000 leads to a tax of €315. And this effect is sometimes called the negative proviso safeguarding progression, because in that particular constellation, the proviso safeguarding progression does not turn out to be positive for the fiscal administration, but turns out to be negative for them. And so, just in a colloquial way to coin a technical term for that, one speaks of the negative Proviso Clause, or in German of the negativer Progressionsvorbehalt. But in principle, what you have here as result is correct, because if you look to the worldwide income of that person was nearly completely poor. Only 10,000 worldwide. Everything which was gained in Germany was lost in other states. So if you really look to the overall wealth when you determine the tax rate, it is completely correct that you grant this person a tax rate which you otherwise only find for people who live nearly from welfare payments. 0.35% approximately. Strange, but absolutely logical. Well, let's now turn to Mrs. H from Hanover in Germany. She has income from several sources again. Income from a shop in Hanover, 200,000. Income from a shop in London, tax-free under a DTT. Income from a shop in Paris, exemption method under the DTT, plus 300,000. Special expenses, etc. blah blah can be deducted 50,000. So let's talk about that. So let's begin. Personal tax liability. H is a natural person, so ESTG applies. We have to deal with unlimited tax liability. Paragraph 1.1 ESTG because, well, lives in Hanover, Germany. So the worldwide income is tax relevant. Now let's check the events. 2.1 shop Hanover, that's income from business, paragraph 15.2, and it has to be taxed by the owner, paragraph 51 number 1 ESTG. So part of the worldwide income, paragraph 2.1 number 2 ESTG. Tax base is the profit number 1 ESTG given as 200,000. Now 2.2 is a shop in London. That's also income from business. 15.2, 15.1 number 1, blah blah, tax base minus 150. But first test if that minus 150 from the perspective of the German Income Tax Act do exist at all. Test paragraph 2A1 ESTG. Under paragraph 2A1 number 1 ESTG, losses from business from a foreign permanent establishment are excluded from the worldwide income, but under paragraph 2A2, these losses are reintegrated into the worldwide income as regular as before if they result exclusively from manufacturing or trading goods in case of a shop. That is the case. So the loss exists for German tax law. Naturally, London is a third state, not EU anymore. I hope you remembered that. So the next question is, but the loss is tax-free. So taxable is an amount of 0. For the progression, the loss is relevant. Under paragraph 32d, 1, number 3, ESDG, amounts freed by a double taxation treaty are relevant. So that was everything we had. So we add everything up. Taxable and relevant for the tax rate. So for the progression, taxable is plus 200,000. So it's relevant too. Then we have we have forgotten something. We have forgotten something. Oh my God, ladies and gentlemen, and nobody, I mean, you stopped me. 3, 2, 3. That was the shop in Paris. Income from business as before. Paragraph 15.2, etc., etc. You would never do that in a case solution. Naturally, tax-free is 0 and tax rate relevant. So relevant for progression is 300,000. Again, paragraph 32b1, number 3, ESDG. Then we go back to that here, and we have now a taxable amount of this. The loss is relevant. Taxable from Paris, no. And then we have the deductible personal expenses, minus 50,000. And now when we add everything up here, that leads to a taxable amount of 150,000 for the rate, which applies to, oh my God, 300,000. Okay. So for 300,000, the tax would be in 2022 0.5 times 300,000 times minus this. So there we would come to 135,000 minus 17,602.28. That would be 117,697, and well, that would be in percent. 107,697 divided by 300,000, and this is 39.23%. Or let's round it this way, and it's better for the layout. And that leads to a tax of 30 on 150,000, and this is 58,848 and some cents, which are rounded down and vanish. Naturally, if your personal result, if you try to make the calculation on your own, if your personal result deviates by 1 or 2 euro, that's probably only due to rounding differences and plays no role whatsoever. So again, a case solved and done with. So let's look for the next case. So here we are again. Now there is another aspect. If a loss shall have an impact on the calculation of the tax rate, then we naturally need, logically, that this loss exists at all from the perspective of German law. So as we already tried to do so in the last case. We have, in case of a foreign loss, to check paragraph 2a if that loss exists at all. And so we are going to show what happens if the loss does not exist by this case. Let's begin to think about it. Okay, so let's begin. Personal tax liability. I is a natural person, and so ESTG applies, the Income Tax Act. She is subject to unlimited tax liability, paragraph 1(1) ESTG, because she lives in Ingolstadt in Germany. So worldwide income is relevant for taxation. The events. Well, 2.1, the job in Ingolstadt, that's income from employment. 19.1, number 1 ESTG, part of the worldwide income, because it's one of the 7 types of income which makes up that worldwide income. Tax base as the surplus of revenue over expense. Number 2 ESTG could show that to you if you looked it up, and so here that's 80,000. Now 2.2, the house in Abrodia. That's income from lease and rent. Paragraph 21(1), number 1 ESTG. Part of worldwide income. Let's rather write it here. Part of worldwide income. Paragraph 2(1), number 6. Now let's eliminate that double bracket. That's not nice. And ESTG. Yeah, tax base is the surplus here given as minus 50,000, so a loss. But as Abrodia is a third state, not a member of the EU nor the European Economic Area, we will have to check paragraph 2a ESTG. Does this loss exist at all for the German tax law, or is it to be completely ignored under paragraph 2a ESTG? Well, here, paragraph 2a 1, number 6a ESTG says losses from immovable property in a third state do not exist. Can only be set off against future profits or revenue, future taxable income from the same kind of activity in the same state. So loss is 0 completely. 2a2 does not reintegrate that amount into the worldwide income again, because, well, that is only done with permanent establishments of a business, and we don't have that here, so no loss exists. So taxable with 0 because tax-free, and relevant for the tax rate under the proviso with its amount under German law, which is due to paragraph 2a. Well, the loss is due to paragraph 2a, the loss is 0, in contrast to economic reality. So when we add everything up, we get taxable and relevant for the tax rate. Now we get taxable is 80,000, relevant for the tax rate is also 80,000. Then we get the house in Abrodia, it's tax-free, and the loss has under German law also a value of 0. It does not exist at all. So then the personal deductions. And so, surprise, we have 70,000, and they are taxed for the rate for 70,000. So the tax is 0.42 minus this correcting factor, that's the value for 2022. If you read or if you listen to that video in a later year, probably the correcting factor has changed, but that doesn't change the logic. And we have 20,132 euro coming out. I have rounded down the figure, and again, it's clear this is a result which is only valid for 2022. The logic and technique remains the same in future years in all probability. And if your personal result with the same tariff function just deviates by some 1, 2, or 3 euros, the explanation is probably that you made some different roundings than I did, and that is not a mistake, but that's natural. We can assume, by the way, that inside the German fiscal administration there are rules how roundings have to be made, but this is not our problem. Okay. Now here's promptly the next case. Mr. J from Jever in Germany has the following income. A job in Jever, 100,000. The loss from a farm in Abrodia, a double taxation treaty country. The farm is tax-free in Germany under the DTT and has a loss of minus 100,000. And we have a profit from a factory in France, tax-free under the DTT France, 200,000. And the special expenses are 20,000. So we have to think about that now. Personal tax liability is again a clear thing. Mr. J is a natural person, so ESTG applies. We have to deal with unlimited tax liability, paragraph 1.1 ESTG, because J lives in the German inland, so worldwide income is in principle relevant for taxation. Now let's look to the events. 2.1, the job is income from employment. Paragraph 19.1, number 1 ESTG. Blah 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 blah, part of the worldwide income. 2.1, number 4 ESTG. Tax base, the surplus of revenue over expense, to number 2 ESTG, and that's here given with 100,000, so he has about a good job. Congratulations. Loss from the farm in Abrodia. That's income from agricultural and forestry activities, paragraph 13 ESTG. Part of the worldwide income under 2.1 number 1 because it's the first thing in the entry in the list. The tax base is the profit. 2 number 1 ESTG. That's here given as minus 100,000. But as Abrodia is a third state, neither EU nor EEA, we have to test if, from the perspective of German ESTG, that loss exists at all. Test paragraph 2a ESTG. Indeed, paragraph 2a1 number 1 ESTG declares a loss from a farm in a third state as non-deductible from the worker income. Only offsettable, if one can say that in English. If not, it's a hapax legomenon, a once and only said word now, which I coined just now. Only offsettable against future profits from same kind of activity in same country. So this year income here is 0 under German law. So tax-free under DTT 0 and tax relevant, well, with 0 because the income is 0 for the ESTG this year. 2.3. The factory in France. Income from business 15.2 plus 15.1 number 1 if our friend is the sole proprietor. Part of the worldwide income in principle. So 2.1 number 2 ESTG. Tax base is the profit to number 2 ESTG. That's here plus 200,000. But tax-free under the DTT, so taxable is 0, but relevant for the tax rate under paragraph 32.1, number 3 ESTG, with an amount of plus 200,000. So if we add things up, we have again taxable income and we have tax rate relevant income. So we have 100,000 here, which are also relevant for the tax rate computation. We have a loss from Agrodia with a 0, and for German law, this loss indeed does absolutely not exist, so it has a 0 also when we take it into account, because taking a loss which amounts to 0 into account just means you take it into account with that 0. Now, the profit in France is tax-free in Germany, but 200,000 count for the tax rate. Now we have 20,000 deductible personal expenses. And so if we sum it up, we end up with 80,000, which we have to pay tax for, with a rate for 280,000. Now 280,000 would be 280,000 times 0.5%, 72. This is the year of 2022. This leads to a fascinating amount of 280,000 times 45%, 126,000, minus 17,602.28, 108,397, and that is equivalent to 38,734%. And now, as the space here is relatively narrow, no, 7,134%, Oh my God, this should be amended. Times 80,000, we end up with a tax burden of 30,970. Well, okay. Also, that case was now solved. Perfect, ladies and gentlemen. We can congratulate ourselves that also that tax case has been solved correctly. Let's wait for further developments. Okay, now let's talk a bit about one special exemption or exceptional situation with regard to the Proviso Clause. You remember that the Proviso Clause says that the tax-free income is relevant for the tax rate computation. Now, paragraph 2a says certain losses are from so-called passive investments are completely ignored. They are not part of the worldwide income, and so they cannot come into play for the calculation of the tax rate. We have already seen that. Now, European law says with investment in other European states, you cannot do something like 2a. You cannot treat foreign investment in an unfair manner, in a worse way than you do it within Germany. So, European law says 2a cannot be practiced with losses from the EU. Now the question is, could that entail any risk for the fisc? Sorry. And the answer is yes, it is. It could. That's a bit difficult to understand as long as you see a concrete example. So imagine the following tax saving model, and it looks like this. Imagine there is a dentist. These people are rather wealthy. And that dentist has, in my imagination, each year an income of 300,000 per year. So if the dentist only has that income, then the total income tax would be 170,000 and some euros. That is approximately 39%. Okay. 39%. That's rather harsh. Now imagine our dentist has the famous idea to invest abroad into a relatively risk-free investment, which fulfills the following requirement. First, it's tax-free under double taxation treaty. Second, it counts for the Proviso calculation. And third, it brings a loss of 300,000 in the first year and later recovers the money with a small extra profit in form of 310,000 euro in the second year. Now, what would be the fiscal consequences? Under the regular rules, that would lead to the following constellation. Year one, you have taxable income and tax rate relevant income. 300,000 from the first activity. Now you pack on top the tax-free investment abroad. 0 for the taxable amount, but for the tax relevance, you have now a loss of 300,000 in that year. So in the end, you have now 300,000 taxable income, but the worldwide income would be 0 and the rate would be 0. By the way, not instead of 31, but instead of 39,000. So I should correct that. So I corrected that now. Now it's 39, and that's correct. So you save approximately 40% taxes in the first year. 100. So in the second year, the situation would then be taxable income 300,000, 0 from the foreign investment, 310,000 count for the Proviso rule. So we have now 300,000 to be taxed with the rate which is relevant for 610,000. This rate is 42,114, because the additional 300,000 do not push up your tax rate very strongly because you are already close to the top. So in the second year you pay 42% instead of otherwise only 39. Now be honest to ourselves. Let's be honest to ourselves. Would that be not a fascinating idea to say we lower the tax by 39% in the first year and that costs us an additional 3% in the second year. That would be such an enormous tax saving effect that one must do something against this. For this reason, it would be highly plausible that people would try to systematically exploit that, and that even the industry, the financial industry, would create tax saving models with the explicit purpose to exploit that effect. For this reason, the legislature in Germany said, well, we can't exclude the losses from the worldwide income altogether in an unfair way, but we can only then exclude the losses and the profits from such investments from the Proviso calculation. So that was the compromise which they did. And then they said, where do we need to do that? Well, a tax saving model is always something which must be relatively risk-free. For example, if somebody says to you, I can offer you to invest into a bakery in Paris, but at the moment produces losses. And you would say, okay, then I have the losses now, but will my money come back? And the answer is then, yeah, certainly. The bakery only has losses at the moment because it's a catastrophe and nobody eats bread in Paris, but I'm sure in the future everything will reverse. Then you would probably say, I'm not so sure. I'm not going to throw my money out of the window for that investment just for a tax saving effect. I do not want to lose 300,000 somewhere where I can't recover these 300,000 with reasonable certainty. So you only need to make such countermeasures for situations which are relatively risk-free. The most important situation which is risk-free is, for example, to invest into capital investment opportunities where, let's say, the money nearly certainly comes back. For example, if you buy a house, it's nearly impossible to lose all the money. If everything goes wrong, you can keep the land and the house and just wait for inflation, and in the long run, your money will come back in the one or other form. Whereas when you really invest into a bakery, the whole thing can really go bankrupt and then everything's lost. So that explains why the legislature in Germany concentrated here on suspending the Proviso rule for profits and losses from the EU in equal way, and the EEA for investments where losses are relatively risk-free, so where it's relatively certain that the amounts can be recovered in the medium or long run. For non-EU countries, that must be clearly kept in mind. You'd never have the problem because there, the paragraph 2a just says, hey, there are no losses which come into play. So due to our unfair treatment of foreign losses, in the normal situation, we never have that tax saving opportunity model problem here. We only have it where paragraph 2a is forbidden. So the suspension of the Proviso rule only exists in cases in the EU and only there where the investment inside the EU is relatively risk-free. For example, you buy a house, let's say in Ireland, which brings 300,000 losses now, and where the losses will be certainly recovered in 1, 2, 3, or 10 years' time. So there is no risk. Then this is a very promising capital investment, and that must be prevented. Okay, so a last terminological aspect should be mentioned. These activities where either paragraph 2a says the loss does not exist, it's completely ignored, or where the rules for the Proviso for EU and EEA investment says, okay, let's forget about the Proviso, it's too dangerous. These activities are usually called passive activities. So these are the activities which, under the perspective of 2a, would kill the loss if they came from a third country. And if you do such an activity in the EU law says, okay, you must treat them fairly, and fairly from our perspective then, okay, then we suspend the Proviso for the positive and negative results from such investments. So we can avoid reproaches from the perspective of European Union law. Okay, so that remark is necessary still, or has been necessary still, to understand fully how the Proviso rules work. But you should not concentrate on that too much. The most decisive part of the rules is that you understand that exemption method says things are tax-free, and that exemption method says when you have a progression, that the progression is usually determined by an auxiliary calculation, the Proviso safeguarding progression rule. Okay, and this game then that certain losses or losses and profits from certain investments are not taken into account for the Proviso rule, that's a rather rare exception. So that is usually not crossing your way. Huh? So the first two effects are really material, the other one is just for the experts among the experts. Some last examples to illustrate that. Imagine we have a taxpayer who has income from a house in the Netherlands, 20,000 euro, and that income shall be tax-free under the DTT Netherlands. Now the Netherlands is an EU state, and a house is a passive investment. Investing into a house is relatively risk-free. So we cannot be surprised that investing into a house in the Netherlands is one of the cases where the Proviso Clause is suspended. You can even check that if you had a loss from a house investment in a third state, the loss would be killed by 2A1. And the general rule is if a loss is killed by 2A1, if it comes from a third state, then it would kill the Proviso for losses and profits from that investment if the investment is tax-free but from an EU state. So here it counts with 0 for both the tax base and the tax rate. Now you have an income from a farm in Spain, loss 30,000. It's tax-free under the double taxation treaty, but the treatment for tax base, for the tax rate is again, it's a passive income. Also that is listed in 2A1. A farm is usually heavily subsidized. It has to get to do with land, so even if you go bankrupt, you sell usually the bank, you keep the land and sell it in the long run for people who want to build houses on the land, and so you probably can't really go bankrupt there. And for this reason, this is also rather passive, and so the Proviso is suspended here. Number 3, you have now income from a factory in France, that's 200,000. That's tax-free, but a factory really has a risk of going bankrupt, so investing there can't be a tax-saving model, and so we have no deviation from our general rules. The Proviso here counts for profits and losses from the factory, so here this 200,000 would be relevant for the Proviso calculation. Imagine furthermore you have income from a farm in Angola, it's tax-free under the DTT. Well, a farm in Angola that's now active. No, it would be passive if there would be a loss. But on the other hand, for a farm in Angola, there are no special rules concerning the Proviso. But there the risk is just killed by saying if the farm brings a loss, the loss does not exist. Plain and simple. Huh? So here we have no problem. You can, in the end, imagine brutal cases like this one. Mr. L from Ludwigshafen in Germany has income from the following sources: a job in Germany, a house in Germany. Both are taxable and therefore also count for the Proviso. Income from a factory in the Netherlands, a loss. It's tax-free, but it counts for the Proviso because the factory is from the EU. Yes, okay, but the factory is not risk-free, so it's active. Income from a house in the Netherlands, 20,000. Well, the house is tax-free and the house from an EU state. There we have to check if the Proviso rules might be suspended, and they are, because investments into a house are risk-free. So that is passive, and here the Proviso is suspended. income from a house in Spain which is not tax-free. Here there is no debate at all about proviso rules and so on and such rubbish, because here it's taxable. And then the only thing which we could debate is, does the loss exist or not? And paragraph 2a cannot be applied. 2a says the loss does not exist at all, cannot be applied to EU state investments. So this loss exists and can be deducted from the tax base, and so it also automatically counts for the tax rate. Factory in Spain, 100,000 is tax-free under the DTT, but factory counts for the proviso. This is a genuine risky investment. It counts. The farm in Angola is tax-free for the tax rate. It counts under the proviso because there is no suspension for the proviso for income from sources from third states. Then you have a farm in Mali, tax-free under the DTT, and it has minus 100,000. Well, if it's tax-free, the taxable amount is 0, and the proviso will apply, but then we have to check how high the profit is from the German perspective. In paragraph 2a will say a loss from a farm in a third state does not exist. So here the appropriate figure for the tax rate calculation would also be a 0. I did not show that to you in detail because first it was a long day, and second, this is a rather harsh and really brutal case. We should not practice too much there. Okay, that shall be sufficient for today. I thank you very much for watching this video when it comes out. Please recommend the channel to others whom you like, or recommend it to others whom you don't like. In any case, recommend it, and enjoy the break till the next video comes out. Thank you very much and goodbye.